Your credit card payment just went up. Your car loan costs more than it should. Your mortgage is eating half your paycheck. And none of that is an accident. Over the past few years, the Federal Reserve raised interest rates 11 times in less than 2 years. And that decision made every single form of debt in America drastically more expensive overnight. Here is what that actually looks like in your life right now. The average credit card interest rate is over 22%. If you are carrying a $10,000 balance, you are paying $2,200 a year just in interest before you touch the principal. Car loans hit 7.4%. For a $40,000 car, that is an extra $150 to $200 per month compared to rates just a few years ago. Mortgages doubled. You could get a 30-year mortgage at under 3% not long ago. Today it is over 7%. On a $400,000 home, your monthly payment jumped from $1,700 to over $2,700. An extra $1,000 a month for the same house, and here is the part that should make you stop cold. Americans did not stop borrowing. They could not. Rent stayed high. Groceries stayed expensive. Insurance spiked. Healthcare rose. So when paychecks could not cover life, households did the only thing left. They swiped. Credit card debt in America just crossed $1.17 trillion. Record. Auto loan debt hit $1.63 trillion. Total household debt is now $18.2 trillion. The highest it has ever been. The problem is not just that debt is high. The problem is that the cost of carrying that debt is exploding. And the Federal Reserve just told the country that rates are staying high longer than anyone expected. I am going to show you exactly why this happened, who is destroying it, and where this goes next. And by the end, you will understand why millions of families are about to financially break under the interest payments they cannot escape. Here is what almost nobody is saying clearly enough: credit card delinquencies are now at their highest level in over a decade. Auto loan delinquencies just hit a multi-decade high. People are not defaulting because they are reckless. They are defaulting because the math stopped working. So why did the Fed do this? One word. Inflation. In recent years, inflation spiked to levels not seen since the 1980s. Prices on everything, food, gas, rent, insurance, shot up over 20% in just a few years. The Federal Reserve's job is price stability. And when inflation runs hot, they have one tool: raise interest rates. The logic is simple. Make borrowing expensive. People spend less. Businesses invest less. Demand drops. When demand drops, prices stop rising, and it worked. Sort of. Inflation slowed. It dropped from over 9% down to around 3%. But here is the catch. Inflation slowing does not mean prices went back down. It just means they stopped rising as fast. A $4 gallon of milk did not go back to $3. It just stopped climbing to $5. So Americans are still paying historically high prices, but now with historically high interest rates on top of it, and the Fed's position is this: we cannot cut rates yet. Inflation might come back. That sounds reasonable until you realize what keeping rates high actually does to a debt-saturated economy. Here is what really happened. The economy, households, businesses, even the government, became addicted to cheap money over the last 15 years. After the financial crisis, the Fed kept rates at nearly zero for over a decade. Mortgages were cheap. Student loans were cheap. Business loans were cheap. Everyone adjusted to that world. People bought houses they could barely afford because rates were low. Students borrowed 6 figures because rates were low. Companies loaded up on cheap debt to fund buybacks and expansion. And then the Fed ripped it all away in less than 2 years. When you raise rates this fast after keeping them near zero for over a decade, you do not just slow the economy. You break the people who built their lives inside the old system. Higher interest rates do not reduce existing debt. They magnify it. When the Fed raises rates, old debt with variable rates, credit cards, home equity lines, adjustable rate mortgages, resets higher. New debt becomes dangerous from day one. Monthly payments jump without warning. And households that were barely keeping up fall behind. The Federal Reserve knows this. But controlling inflation comes first. Everything else comes second. Now let's talk about who this is actually destroying. Middle-class households are using credit cards to pay for groceries, utilities, car repairs, and medical bills. With credit card rates above 22%, balances grow faster than people can pay them down. A $5,000 balance at 22% interest, paying only the minimum, takes 15 years to pay off. And you will pay $7,000 in interest alone. For millions of families, credit card debt has quietly become a life sentence. First-time homebuyers are locked out completely. High mortgage rates did not just make homes more expensive. They made homeownership mathematically impossible for an entire generation. At 7% rates, monthly payments are so high that fewer people qualify. And those who do qualify are paying hundreds of thousands of dollars more in interest over 30 years for the exact same house someone bought years ago for half the cost. Homeownership used to be the foundation of middle-class wealth. Now it is a luxury reserved for people who already had money. Small businesses are choking on variable debt. Many small businesses rely on credit lines and variable rate loans to operate. When rates spiked, their monthly payments doubled or tripled overnight. Expansion stopped. Hiring froze. Layoffs followed. Big corporations with cash reserves can survive high rates. Small businesses, the ones that employ half of America's workforce, cannot. High rates do not level the playing field. They tilt it even harder toward the already powerful, and here is the number that should genuinely shock you. The US government itself carries over $34 trillion in debt. When rates rise, refinancing that debt becomes drastically more expensive. Recently, the government paid over $1 trillion just in interest on the national debt. That is more than the entire defense budget. Every dollar spent on interest is a dollar not spent on infrastructure, healthcare, education, or anything that helps people. When debt payments consume household income, spending slows. Businesses lose revenue. Defaults rise. Growth weakens. This does not happen all at once. It builds quietly. Credit card companies report delinquencies rising. Auto repossessions tick up. Bankruptcy filings increase month after month. There is no dramatic crash. Just a slow economic strangulation. Until something breaks. So where does this go? In the short term, rates stay high. The Federal Reserve has made it clear they want absolute proof that inflation is dead before they cut rates. That means debt stays expensive for the foreseeable future. Households will keep juggling payments. Credit card balances will keep rising. Delinquencies will keep climbing. And millions of families will stay trapped in a cycle where they are paying hundreds of dollars a month in interest just to tread water. If the economy weakens, rate cuts will come too late. Eventually, if defaults spike and economic growth tanks, the Fed will cut rates. But by then the damage is done. Families will have already drained savings. Businesses will have already closed. Credit scores will have already been destroyed. Rate cuts do not erase the financial carnage left behind. And here is the brutal reality. High interest rates do not erase debt. They weaponize it. Every month rates stay elevated, debt does not shrink. It compounds. Minimum payments rise. Balances grow. Payoff timelines stretch into decades. And unless wages rise faster than interest costs, which they are not, debt will keep getting worse. Not dramatically. Quietly. Steadily. System-wide. So what do you actually do right now? Understand first that this is not a personal failure. If you are drowning in interest payments, it is not because you were irresponsible. It is because the Federal Reserve made a policy choice that directly increased your cost of living. Act strategically. If you have high-interest debt, credit cards above 20%, attack it aggressively. Pay more than the minimum. Consolidate if you can. Refinance variable debt into fixed rates if possible. Stop taking on new debt at these rates unless it is life or death. Financing a car at 8%? A vacation on a credit card at 22%? You are signing up for financial destruction, and pay attention to what the Federal Reserve does next. When they cut rates, refinance immediately. When they hold rates, prepare for the squeeze to continue. The Federal Reserve controls the cost of money in this country. And right now they have decided that controlling inflation matters more than millions of Americans' ability to keep up with their debt payments. That is the trade-off. And you are on the losing side of it. If this clarified something you have been feeling but could not explain, share it with someone who needs to hear it.